Hello, listeners, and welcome to the Montel Weekly Podcast, bringing you energy matters in an informal setting. This week, EU energy ministers agreed a deal to impose a price cap on wholesale gas markets. We thought this was a significant move and warranted a special edition of the podcast. What was actually agreed, and what impact will it have? Will it shield market participants and, by implication, industry and households from high prices, or could it make problems even worse? Helping me, Richard Sverrisson, to discuss the issue and the ramifications of the price cap is James Waddell of Energy Aspects. A warm welcome to you, James, and great to have you back on the pod.
Thank you, Richard. Nice to be on.
So let's go first into the background, James. Why a cap? What's the benefits of a cap?
Well, look, the European Union and all the member states have been facing the same problem, which is high energy prices, high gas prices, effectively making the energy industry and gas-intensive industry uncompetitive within Europe. So that's a huge problem for GDP, for economic growth within the Union. It's also translating into very high prices ultimately paid by households, both in form of how energy prices are translating into high costs and just squeezing budgets for people to be able to afford both food and heating at home. So the response has been at a member state level, but it's been pushed up to the EU level to try and come up with some sort of limit on the amount that people would actually ultimately pay for gas. And the theory is that Europe as a massive gas buyer could function as some kind of monopsony in terms of being able to dictate what price it actually pays for gas, even if that's delivered from pipeline grids towards Europe or from ultimately the LNG market towards Europe, and to try and put some sort of check and balance on that one. There have been individual member states that have been trying to do individual things to either reduce demand or subsidize the price, but this is a EU-wide level, and really it's been spearheaded by a lot of member states, mostly in the south of Europe, to try and push this forward.
So I think before we go into the details of maybe how they arrived at the number and also the sort of background to the sort of the deals going on at the European level, I mean, how would a cap then work in practice, James? Just generally, if we thought theoretically here, will it force suppliers to ship more gas to Europe?
Well, there's a danger in putting a cap in place. Now, if you're looking at most global supply can deliver at prices well below the level that Europe is trading at the moment. If you're thinking about an upstream producer in Norway or an upstream producer in Algeria or any sort of LNG producer, their actual production costs will be far below the level being paid by Europe. The trouble is that we're not on a sort of cost plus basis for global supply. We're competing in a global market for mostly LNG cargoes, and that has been the main replacement for Russian gas since we've had this withdrawal and this weaponization of Russian supply. And that means that we need to maintain a competitive edge, mostly over the Asian market, to some extent over the Latin American market, to bring those LNG cargoes in. And so what is being discussed in terms of the cap is to put an absolute level that you can transact at the exchanges in order to bid or make offers or trade gas within Europe. And the risk that has been seen by some European countries is, if you put a cap on that price, are you going to lose competition to Asia or to other global buyers for LNG cargoes coming into Europe? Now, there have been a bunch of safeguards they put in place to prevent that happening, but that has been a major ongoing concern as they've been going through the negotiations.
I mean, we'll return to that later, James. But have there been instances in the past where a cap has actually worked, been successful?
Well, this is really an unprecedented measure being taken at the European Union level. We had the director of ACER coming out publicly yesterday and saying this is a risky thing that is happening within the EU at the moment, and it is untested. What we've tried before is at a national level, tried to set various caps. You can look at the Spanish system where they've put a maximum price that you can translate into the power price that you ultimately pay. If you're a gas-fired generator, you can only translate some of your gas costs, and the rest of it effectively gets cross-subsidized. So there are ways of doing that. The trouble, what we saw with the Spanish system, was that was inflating gas demand. And at the EU level, we've had such a supply shock where effectively you've lost about 70 to 80 BCM of Russian gas in the space of a year, and you're going to lose another 50 BCM in the course of next year. You're really having to manage that demand side. And if you're going to be putting in an artificially low price that is going to inflate demand and potentially jeopardize some of the LNG cargoes, you're setting Europe up for a potential even worse crisis down the line.
So in a sense, it may drive supply elsewhere and actually drive up demand. So really, in effect, exacerbating the problems that we have in the first place. Is that what you're saying, James?
Well, exactly. Well, that was as the initial proposals were coming through, that was the main concern, right? There were a bunch of states that were arguing for a cap that was very low, not too far from market values at the time, and it would have been activated on quite a frequent basis. Now, we've got to remember that the way that gas is bought within Europe is not all on the exchanges. And what has ultimately come out of this is that it's a targeted cap on purely gas trading, basically within 2023 on a monthly or even a front year basis, but up until the end of 2023, for gas being traded on the ICE exchange, on the EX exchange. There's some confusion as to whether this would apply to, for example, the CME exchange, whether that is covered by EU jurisdiction, but it does not cover the OTC market, and it does not cover the spot market. So effectively, day-ahead trade, weekend trade, balance of month trade, that's not covered by this cap. And everything which is done outside of the exchanges is not covered by this cap. So in effect, there are enough workarounds that will ensure gas can flow across borders. If you've got Austria bidding up aggressively against the Dutch market, that gas will be able to flow. It won't all be set at the same price level across Europe. And in terms of attracting LNG cargoes, well, you can still effectively buy an LNG cargo. It's just very difficult to hedge that on the exchanges if you're at the cap level. But you can still buy it on an OTC basis. So there are enough workarounds that effectively mute the impact. And we don't really see any net effects overall in terms of how much people will ultimately pay for gas within Europe because of these workarounds.
So these workarounds, as you say, or what can you say, the ways of really could result in the cap being pretty ineffectual. If you're saying then what could happen is that, okay, they'll drive trading onto OTC, over the counter, into the brokered market, off the exchanges. I mean, that's obviously going to affect exchanges in one way, but or the spot. I mean, so there are ways of working around it, making it just basically a symbolic measure.
It does seem to be mostly a symbolic measure. If you think about the communication from the Commission, it was more about indicating that Europe was not prepared to pay any price for gas. But ultimately, the truth is it will. If we're looking at a situation where it is very cold in Asia, it's very cold in Europe, and we're running low on storage, and we've got Japan bidding aggressively for LNG cargoes, well, there's going to be this competition, as we saw for a lot of 2022, to try and bring those cargoes in and try and win those spot cargoes into the European market. And effectively, what that's going to do is just drive as much of that liquidity onto the OTC market. So yes, it is really a challenge in terms of shifting liquidity from certain markets and actually endangering some of the trade that we would normally do. You'd normally hedge a cargo for Europe on the TTF exchange, and that may not be possible if you're getting up to the cap level, just because the prices won't be able to follow because they'll get cut off at a certain level. One thing that was added in fairly last minute was the cap was allowed to be dynamic. So there are two triggers for the cap. One is an absolute price level, which was set at 180, and the other one was a deviation from a new LNG reference price to be published by the Agency for the Cooperation of Energy Regulators within Europe. And that LNG reference price, which isn't strictly an energy reference price, it also includes the NBP UK hub. If that one moves higher than, for example, 45 euros, then the cap is no longer set strictly at 180. It can, as long as it can maintain basically a 35 euro spread to the LNG reference price. So if the LNG reference price goes to 200, you can, in theory, trade it to 35, and that's still okay.
Okay, so that's that came in at the last minute then as a backstop issue or measure. But So those are the details. So the cap is set at 180 euros a megawatt hour for the TTF, or the Title Transfer Facility, which is the Dutch gas hub, for the front month prices. And it needs to be 35 euros above an LNG reference price. Is that correct?
Yeah, so it would affect actually all trading, as far as we understand, within with expiry within basically 2023. So it would be in place. I mean, it's still fight. Although they've agreed on this at the European Council level, there is still an impact assessment to actually determine whether this will finally go ahead, and that's due by mid-February. But effectively, from that date, you will have a cap in place which will restrict the absolute price level, and it also has to be a deviation of more than 35 euros from the energy prices. And both of those preconditions need to be in place to trigger the cap. And that second precondition is actually very interesting, because what we've seen this year is a big deviation in those hub prices from energy prices on the water. A lot of that has been to do with congestion around European regasification infrastructure. And a lot of that is being solved over the course of this winter and into next year, with a huge build out of regasification capacity in Germany, for example. In Finland, we're getting some terminals in Albania and Italy next year. All of that is kind of rejigging where you can put LNG cargoes into Europe, and should stop a lot of that disconnect between LNG on the water and pipeline grids within Europe. That means that second precondition may actually prevent the cap from being triggered, even if you get prices going up to 200, 250, etc. So that's going to be one to really monitor next year. But it will apply to the TTF, be triggered by the TTF, but it will also apply to other European gas hubs. And that was also something that came in fairly last minute from the Czech Council energy meeting at the start of the week.
So it's not just the TTF, that's an important point. But it also needs to hit those prices for 3 consecutive days. Is that correct?
That's right. It has to hit it for 3 consecutive days, again, with both preconditions. Once that cap is triggered, it's in place automatically for 20 days. And then it will be 3 days of the preconditions not being met to actually bring the cap offline and allow free trading again on the European exchanges.
With regard to this LNG reference price, how is that set, and who sets it?
So the LNG reference price is going to be a new published price by the Agency for the Cooperation of Energy Regulators within Europe, ACER. It's going to be a composite of a few different prices put forward a lot by both S&P Global or Platts and Argus Media, which is going to be one Northeast Asia price, which is the JKM in the case of Platts, or the Argus Northeast Asia price in the case of Argus. Plus, you're going to have a Mediterranean delivered LNG price, again assessed by both of those PRAs. It will also have a Northwest European delivered price, and also the NBP price will be taken into account as well, again quoted by ICE. Now, that basket will be then an arithmetic average of those 4 main delivery points, and that will be determined to be effectively the LNG price. Now, why the NBP is included in that is a bit of a mystery if it's strictly an LNG price. But the theory is that these prices represent some kind of global fair value. And what happened over the course of 2022 is that the TTF was dislocated from that fair value, and it was bid up on the market for strange reasons which were not really identified. And the trouble with that analysis is it's not really what was actually happening. If you look at these so-called fair global prices, these are really derivatives of the TTF. And you saw this huge supply shock of Russia not delivering gas over the course of this year, the TTF skyrocketing and trying to attract all of the LNG on the water to come into Europe. Now, the dislocation happened, yes, because of that congestion on regasification infrastructure within Europe. So that limited the amount that you could actually get the LNG in. You were getting unloading slots within Europe clearing for about $15 MMBTU. So that means if you're pricing the TTF at 70, then you could be pricing LNG on the water for delivery to Europe at 55. That is not a fair, normal global price for LNG. If you're looking at the JKM market, that went up to $70 in the middle of August. That's amid extremely weak Chinese demand over the course of this year and fairly adequate global supply. So it's not like there was this global fair LNG price and the TTF was just skyrocketing above it. No, the European price was dragging everything up, and it was only not able to drag it up to the full extent because of this bottleneck in getting LNG into the European pipeline grid. So there's been a bit of a misconception going into European policymaking to kind of put these prices in as one of the preconditions.
Because they saw TTF prices skyrocket. That's what triggered a lot of the intentions to try and shield gas consumers, whether it be industry or households, from such high prices. But actually the analysis of why TTF prices rose and the global dynamics was maybe lacking a bit there.
This belief that the LNG price was just some sort of fair price and the European gas price was not a fair price. I mean, obviously, we have to have high prices because the dynamic is that we're trying to eliminate a lot of industrial gas demand within Europe, and we're trying to attract so much LNG. We've had this huge supply shock. So prices had to go up. It's just, did it go up too far? And that's the question that a lot of regulators have been trying to grapple with. And putting some kind of arbitrary line at maybe sort of TTF prices at 100 was okay, maybe at 150 was okay, but 200 was too much and 300 was too much. So it really wasn't based on a very firm set of analysis in terms of what is deemed to be excessive. And a lot of the wording has been excessive prices. Well, any price above 40 euros, which is the historic trading range of TTF, would be historically deemed to be excessive. So I think that has been a bit of an issue. And the other thing is that we're talking about the exchange-based trade of literally thousands of transactions on a daily basis if you're looking at the ICE exchange or the EX. And this is now going to be regulated to some extent by an LNG price assessed by PRAs. And a couple of these prices have just not been of high relevance for many years. The Northwest European delivered price or the Mediterranean price, there's not that much visibility on it. There's very few price points going into those assessments. So you're looking about maybe 4 or 5 transactions or bids and offers going into a PRA, potentially affecting the trade of 1,000, 2,000, even 3,000 daily trades on the exchanges. And this is a real issue in terms of thinking about manipulation of the market, in terms of regulation of the market. And we know that ACER is trying to bring in people to kind of monitor this on an active basis. But this is going to be a real test going forward. I mean, even if we look at the JKM market and sort of accusations about whether certain market participants are driving up the price, if you're looking at the Northwest European DES price and the Mediterranean price, there are just so few pricing points that are going into those measures relative to the liquidity on the exchanges.
So that was going to be my question as well here to you, James, about the robustness of that LNG index. I mean, there must be some question marks around that.
There'll be questions about that also on the timing of the publication of these indices, right? If you're at the level of the cap, then you know if there's been a transaction on the LNG side, on an X point in time, and that's going to feed into maybe a market on close or maybe a PRA assessment at a certain point. Is that then going to translate the following day into an upping of the cap, or is it not? I mean, will people have advance notice on the basis of a few indications that have been submitted? So there are a lot of potential pitfalls in terms of having this as a potential stop out for the exchange, and this is partly why ICE has been messaging that if we have this cap in place, there are risks to financial stability. There are rumors about whether ICE would want to then stop offering the TTF basically within Europe and actually move out of the jurisdiction within Europe and move back basically away from index and towards the UK where they used to offer TTF trading. So there are real risks in terms of what will be happening on the exchange as a result of this measure. And we're still waiting really for an impact assessment. A lot of this price cap was put forward under Article 122 of the EU, which meant that there wasn't really that time. It was council approved. There wasn't really that time to run a lot of impact assessments. Those are being run, and ACER is involved in that. The ESMA is involved in that. And that impact assessment is due by early February. And it's still is possible that they will say that the risks outweigh the benefits, in which case it will become a difficult decision to actually impose the cap at that point.
Do you think this is a sort of realistic threat that ICE could actually, give up the TTF or and relocate?
There is this possibility, and it really depends on further work, I think, by the EU in terms of outlining, what jurisdiction is covered, whether exchanges like the CME, for example, that also offers TTF trading, would be covered by this measure, or whether it really is just the sort of European registered exchanges or not. I think it's still to be seen. But the movements of liquidity as a result of this measure, not just is the exchange going to move or is it going to stop offering the TTF? They've certainly warned that they may stop offering the TTF. There may not be a viable product with the imposition of the cap because it'd be very difficult to calculate. Some of it's to do with margin calls and other issues that they have to face on a daily basis. But also you've got, the UK hub is obviously not covered by this. And whether you would get trading of any liquidity to the UK hub, I mean, the trouble with that, obviously, is that the UK is not a very good pricing point for the delivery of LNG into Europe, given the disconnects that we frequently see between the NBP and the rest of European hubs, but it isn't affected by this cap. So it potentially could be used as a hedging measure for LNG. And there is also potentially also opt-outs within other hubs within Europe. So whether you're actually covering literally all of the hubs within Europe, whether the Austrian hub, whether the German hub will ultimately be covered by this measure. It's a sort of an opt-out system at the moment. So,
I mean, it's fascinating in a sense, isn't it? Because the cap, the best intentions is to shield the consumers, users of gas across Europe from very high prices. But by imposing such an arbitrary number and the way that it is sort of worked out, the mechanism behind it, it's opening up a huge can of worms, both regulatory, both in terms of market manipulation, as you're saying here, and how, I think it's, the complexity of the details here. The devil is all in the details, really, isn't it, James?
It is. And I think there's been huge political pressure to get this done. You've had very resistant states within Europe, which were saying this was a bad idea from the offset. You've had some states that have basically been trying to push what is a European problem, up to that European level. But in truth, the best ways to deal with this energy crisis is not to try and invent a price that you'd like to pay, because ultimately, if you need that gas, you will ultimately end up paying, right? Even if you were to put in a cap and say, we're going to put this at 100, but the LNG starts disappearing overseas, well, the initial plans were, states will allow energy companies to bid up to 200 or to 300, and then they'll get cross-subsidized. So you don't see the impact of high costs on your utility bills, but you do see it in your taxation that you then pay to your governments the following year. So there's no real getting away from the fact that we're in a globally competitive market for LNG, and the only way to realistically lower the price that we're paying across Europe is to do something on the supply-demand balance. And we tried everything we can on the supply side. We've got very strong production coming out of Norway. We've got stronger production next year likely coming out of Algeria. Again, Azerbaijan is producing a lot, and a lot of European production is coming back in. We've tried everything on that front. We've lost so much Russian gas that's not quite making it up. So it's all about what can you do on the demand side. And we tried basically back in summer at the European level to say, look, you need to reduce your demand by basically 15% over August through March. We've been very lucky over the early part of Q4 in terms of getting some mild weather conditions to help us along on that effort. But a lot of the states that were proposing the cap were very resistant to that type of demand measure reduction. If you looked at Spain and Greece, the two of the biggest proponents of the price cap were really sort of arguing that they had derogations from any commitment to reduce demand. But this is the only true effective way that Europe can adequately deal with the supply shock until we get a next big wave of supply coming in mid-decade in the form of LNG and the next big build-out of Qatar's liquefaction and the US liquefaction.
Absolutely. So demand is the key, reducing that. And I think some states have done better at this than others. But I think the final question really, do you think the cap will actually be triggered if it's put into place as it stands today?
What we've had is delivered prices within Europe have been trading at times $20 below where the TTF has been. And that would definitely have triggered the cap in those instances. But the cap is set at 35 euros megawatt hour, which is roughly the same as $11 MBTU. So in the middle of the summer, that would have been a trigger. The thing is, we've now built out so much new regasification capacity within Europe that dislocation shouldn't really occur going forward. If you look at prices on the CME right now, for the delivered price versus the pipeline price versus the TTF, you're looking at differentials that are, within $5, or close to parity at times. So that means that second precondition for triggering the cap shouldn't really happen over the course of next year, in which case, even if we get really high TTF prices, that should prevent it from occurring. The other thing is that even if it was to be triggered, because of what we've been discussing in terms of liquidity issues and potential manipulation of some of the assessments that could be very problematic, the Commission has many avenues to effectively quickly suspend the cap, even if it is put in place. You don't have to wait that 20 days minimum for the cap to be in place. You can just get the Commission saying, this is causing X or Y problem, and therefore we're going to suspend it effective immediately.
Because, I can imagine a situation, it's sort of spring 23, the price gap is in place. Gas storage operators across Europe, say Germany, France, Netherlands and Italy, can't fill storages because no one is selling, there's no supply. How long would the price cap last in such a situation?
Well, yeah, the other thing, we've got to remember that the OTC market, is still effectively functioning at that point, and the spot market is effectively still functioning. So there would be a mechanism by which they could probably get that supply. But again, if you're pushing things towards the OTC market, you've got to remember that you're increasing counterparty risk in those transactions. Yes. And so that's another risk that the Commission would come in and say, this is actually a danger for the stability of gas trading and the actual operation of the gas market. And so they may want to intervene on that point. But yeah, there are many scenarios that could take us up close to the level of the cap, if not above the level of the cap. Now, a lot of what has been triggered already in terms of the Russian shortfalls, we've pushed up to north of 300 at times in August, and that was starting last year, or starting this year rather, kind of close to or a bit sub 100 euros. As we're kind of ending this year again. So it's possible that we could get up there. Now, what it would take, it would be, as you say, very cold weather in Europe and Asia that could really boost the amounts of gas demand that we have. There were concerns, obviously, in the summer about the stability and the security of European pipeline infrastructure after the Nord Stream 1 and 2 explosions and basically effectively acts of sabotage. So if you were to get a cold Q1 in Europe and Asia, plus some kind of disruption on Norwegian pipeline grid supplying to Europe, you could easily get up to the level of the price cap in absolute terms. But what I think may stop it being triggered is again, that LNG reference price being much closer to the TTF next year than we've had this year.
James, well, a lot. Thanks so much for highlighting and illustrating a lot of the complexities involved in this. It seems, maybe, a simplistic measure to put in place, but actually the consequences are enormous, and especially the unintended ones. So thanks very much for explaining what is being put in place and what the implications of that are. Thank you, James, for joining the Montel Weekly podcast this week.
Thank you, Richard.
So listeners, you can now follow the podcast on our own Twitter account, aptly named the Montel Weekly Podcast. Please direct message any suggestions, questions, or, let us know if you think you have a good idea for a guest on the show. You can also send us an email to podcast@montelnews.com. Lastly, remember to keep up to date with all that's happening in energy markets on Montel News. You can subscribe on Apple Podcasts and Spotify, or wherever you get your podcasts from. Thank you and goodbye.